So good afternoon, and first of all, welcome to today's webinar, which is jointly hosted by BDO and Clydesbank. My name is Danny Dartnell. I'm a partner at BDO in the business restructuring team. We're covering the Thames Valley region. And I'm joined by John Stout, who's a senior director at Clydesbank, who will be introducing himself shortly. And one of his colleagues, Gareth Jones, who I understand is going to be facilitating the Q&A session after the formal presentations. We also have colleagues here from both BDO and Clydesdale who aren't going to be speaking during the session, but welcome to you too. And just before we kick off, just a couple of sort of housekeeping points to raise. So the first is that we've got an hour scheduled for this webinar. We will try to keep the presentations to time. We're going to be speaking for about 20-25 minutes each, and that should give plenty of opportunity for questions at the end. We're going to keep the Q&A session to the end, just because that will probably help with timing. But you can, of course, submit questions at any time. There should be a button at the bottom of your screen that says Q&A, so you can submit those whilst I'm speaking. Then John will speak, and then we'll wrap those up at the end. We've got Kevin Hunter from BDO who's on the line. He's doing all of the technical stuff, and he'll make sure those questions are fed through. And Kevin's also told me that I need to, for legal reasons, tell you that this session will be recorded. That shouldn't create an issue, as I understand that participants, you can't unmute yourselves and you can't show your video. So even though it's recorded, it should just be John and myself presenting, and then any question and answers that we have at the end. So without further ado, I'm going to kick off with my presentation before handing over to John later. So before I started, I just wanted to speak briefly about the genesis of this webinar, which came from a conversation I had with Henrik from Clydesdale, who's also dialed in, back in August, where I'd recorded a session on how businesses should be planning for their exit from lockdown. And this session was therefore supposed to be a sort of a look back at lockdown and how the world was supposed to be returning to normal in the lead up to Christmas. Now, the reality is obviously very different. We are not where we thought we were going to be at this moment in time in the midst of lockdown 2. So planning this presentation has been a little bit tricky and thinking very closely about content. And I imagine it's been a bit like being Donald Trump's press secretary, which is that you think you've got a press meeting that afternoon or the following day. You think you know what you're going to be talking about, but the real world is moving so rapidly around you that things change on at a pace. So what I've done is I've tried to break down my presentation into 2 key areas. The first is to talk about some restructuring stroke rescue considerations. And I promise you that's not quite as scary or hopefully as boring as it sounds. There are some really interesting developments in our line of work, which we think it will be useful and interesting for you to understand further. And then the second was to pick some key themes, the sorts of things that we as advisors are seeing at the moment. I obviously have the benefit of speaking with lots of companies on a daily basis. I regularly speak to other advisors, so banks and lawyers, so I can sort of give you a flavour of some of the things that we're talking about on a regular basis. So next slide, please, Kevin. Thank you very much. So you can't have a presentation from a restructuring partner and who's also a licensed insolvency practitioner without some sort of insolvency angle. And the first thing I wanted to note was that we actually have very low levels of corporate insolvency so far this year. And overall, we're about 30% down on where we were last year. And if you think where we are at the moment and what turmoil we've had during 2020, that is hugely counterintuitive. And if you'd asked me back in April and May of this year, I definitely would, and in fact did, predict that there would have been a significant uptick in corporate insolvencies by this stage. And it reminded me of the definition, or one of the definitions, of an economist, which is an economist who will tell you, is someone who will tell you today why what he predicted yesterday didn't happen. And it definitely feels a bit like that. Now, there are some sectors which have been really heavily impacted by COVID, as you would expect. So leisure, hospitality, hotels, bars, restaurants, care homes is another sector that we're seeing quite a lot of stress in at the moment. But as I say, the number of actual business failures is pretty low. And this is down to a number of factors. The first, and I think most importantly, is the actions that management took in March and April as we went into lockdown to deal with that crisis as it unfolded. And I think it's fair to say that we have been immensely impressed by management teams, their ingenuity, the urgency that they had at that stage, and literally having to reshape their businesses in some instances overnight to deal with that crisis. The second thing we've seen is government intervention, which really has seemed to have had the desired effect. So that's through providing liquidity to businesses through banks and funders, so CBILS loans, syllables loans, bounce back loans, the introduction of the furlough scheme, which has been taken up by millions of corporates in the UK, and also a sort of a moratorium on enforcement action from creditors, so effectively stopping dissenting or aggressive creditors from taking enforcement action against companies and forcing them into an insolvency process. And all of those actions have had a fairly significant impact on this sort of depressed level of corporate insolvencies. But alongside this, we've actually had a new insolvency regime which was introduced at the back end of June this year. And this was legislation which was already being discussed. It was effectively already in the pipeline, but it's been fast-tracked. And the reason it's been fast-tracked is that these new measures, these new tools, were deemed to be rescue measures by the government, who obviously decided that these would be incredibly helpful tools to have in our locker during lockdown and in the period after lockdown as we hopefully try to get back to normality. And there are three new tools in this toolbox that the new legislation has given us. The first is what's called the restructuring plan, which is pretty similar to what you'll have seen before, a company voluntary arrangement or the scheme of arrangement, which is included in the Companies Act, which gives a company the ability to restructure its balance sheet and effectively compromise creditor claims. So that's either reducing the amount that you're going to have to pay to creditors, so they're not going to get everything they're entitled to, or timing, i.e. they're going to get what they're entitled to, or it's going to take longer than they should be paid. Or usually both. So you're going to compromise your creditor claims in terms of value and timing. But the main difference with this new restructuring plan is it includes something called a cross-class cram-down, and you definitely have to say that slowly. And what this enables a company to do is to start to parcel up different types of creditors and treat them differently. So some creditors, as part of this restructuring plan, may be paid in full. Some may be compromised and get a proportion of what they're entitled to, either in terms of value or in terms of timing. But some creditors who may have no economic interest could be excluded altogether. And this is something that you can't really do with a CVA, which is treating different types of creditors differently. Now, it needs to be sanctioned by the court, but it gives huge amounts of additional flexibility. And this may be a really important tool in restructuring balance sheets as we come out of lockdown. And I'll speak a little bit about why that might be later. The second new tool in the armoury is called the standalone moratorium. This, if you haven't heard of a moratorium before, what this means is it's a legal protection from a creditor from being able to take enforcement action. So that might be the landlord forfeiting over the lease, or it might be a creditor trying to repossess assets or stock. And a moratorium is available through administration, which you'll all have heard of. But the problem with administration is, whilst that was originally supposed to be a rescue technique, the reality is administration is already a byword for liquidation or the end of the business. It's not really seen as a progressive rescue tool. But this new standalone moratorium is designed to provide that protection for a short period, which is initially 20 business days, so effectively a month, but it can be extended for up to a year. And a monitor is appointed over the company who has to be an insolvency practitioner during that period. But this is supposed to be much more like the American Chapter 11 model, debtor and possession model, where the management team, despite the fact the moratorium is in place, the management team retain control of the company. They're still trading the company, still making key decisions. But they use that short period of protection to rescue the company. So that might be to propose a CVA or a restructuring plan. It might be to negotiate with some dissenting creditors, which is why you need the moratorium in the first place. It might be to raise finance, whatever it might be. But in essence, it gives a company breathing space to put into action a rescue plan. Now, one of the key criteria is that you have to be able to use the moratorium. There has to be a statement from the monitor that the process is likely to result in the rescue of the company as a going concern, not the business, so via a pre-pack, etc., but to actually rescue the company, which is why it's so different to what we've had before. And that's quite a high bar to have to sign off to, but it is quite an important consideration. And the third and final clause, or final tool in the armoury, is called the ipso facto clause. And this relates to clauses that you almost certainly have in your agreements with suppliers or with your clients, in fact, which allows parties to terminate a contract in the event of insolvency. Now, what the new Act does, it says those clauses can't be enforced where there's an insolvency and the goods and services being provided are critical. So what this effectively allows is a company to continue to trade without disruption, despite the fact there's an insolvency event. Now, there's lots of exceptions and exemptions for small suppliers, but again, another tool that it's certainly worth being aware of. So that's the new insolvency regime. Now, a couple of other things to mention just where there's an insolvency angle. First is around creditor enforcement action. And there's an effective stay on those actions at the moment. And this has been extended through to the end of December this year. That effectively makes it very difficult for a creditor to issue a winding up petition or to send in a stat demand and effectively force a company into a formal insolvency or liquidation process. And that is almost certainly one of the key reasons why the number of corporate insolvencies this year has been so low. So that we certainly view that as a very important extension and as real sort of meat on the bones of the government initiatives to protect businesses during this difficult period. The next issue I wanted to raise was around wrongful trading, and this is one of the areas which I think we've probably had the most questions raised about. So just to confirm, wrongful trading is where a director could potentially be held personally liable if they trade a loss-making company where they knew or ought to have known insolvency was inevitable. And these wrongful trading provisions were suspended during lockdown, but that suspension came to an end at the end of September this year. So any insolvencies that occurred during that point, the courts were effectively told to assume that any worsening in the financial position wasn't the fault of the directors. Now, that position or that provision hasn't been extended, so that ended at the end of September. So wrongful trading is back on the table. But I have to say, as an insolvency practitioner, our team's view was that this was always a little bit of a red herring. Those sorts of actions are really difficult to prove, they're really difficult to bring in court, and lots of the other onerous provisions for directors remained in play. So they still had fraudulent trading risks, director disqualification risks, misfeasance claims. So in fact, we don't see the fact that that provision hasn't been extended as being a major issue anyway. And then finally, just on sort of restructuring and rescue considerations, you may or may not be aware that HMRC's preferential status is due to be reintroduced from the 1st of December. For those of you who've been around a while, I now have been. I remember when HMRC did used to be a preferential creditor and it was abolished, and they are stepping back into those shoes. But what does that mean? Well, if there were to be a formal insolvency, they now rank ahead of all the other unsecured creditors for any unpaid VAT and PAYE. Whereas historically they were just ranked pari passu, so alongside all those unsecured creditors. So they get paid in advance of unsecured, but they also now get paid out in advance of floating charge creditors. So banks effectively. What does this mean? Well, it means a couple of things for you on the call. The first is that it might be harder to get funding because lenders often rely on those floating charge assets to secure their debt. And because those assets are going to go to the taxman first, there's going to be less available for those floating charge holders, which means they may be less generous with their funding. But also, if you have a client that goes into an insolvency process and you're owed money, where you may have received a dividend historically, the chances are that the chances of getting a meaningful dividend are significantly reduced. So that's been a bit of a whistle-stop tour through all things restructuring. There will, of course, be an opportunity for specific questions on those at the end. But what I'm going to do now is move on to some of the key themes which we're talking about to companies, to directors, to management teams, to lenders, and other advisors on pretty much a daily basis. And the first of those issues is what I'm calling the debt overhang. And this is the debt that businesses will have accrued this year. So from the period from March through to date, and debt that is going to need to be repaid. So this is excluding furlough payments and grants, which obviously don't need to be repaid, but it very definitely includes CBILS loans, syllables, bounce back loans, the VAT deferment from HMRC or any other deferments from HMRC that you may have taken advantage of. But it's also going to include things like trade creditor stretch, where they're going to need to be caught up, or unpaid rent to landlords. And the key question really is how companies intend to deal with this debt and what assumptions they've made around how long they're going to have to repay it. And you know, the difficult question for all of us, which is what are the trading conditions going to be like next year when the repayment of these debts starts to kick in? And I suppose that brings you back to the point I made earlier about the new restructuring plan and how important that might become. If we've got businesses that have, companies that have really ropey looking balance sheets as a result of this debt overhang, but underneath that, they're really, really good businesses. But what they need to do is free up working capital and debt capacity to be able to compete going forward. And as an insolvency practitioner with a couple of recessions under my belt, what I can tell you is that experience tells us that insolvencies often rise as you come out of a recession. And that's because companies who've been able to sort of hold on by their fingertips during difficult times become hamstrung when things start to pick up. So they don't have the working capital or the capital base to invest in new products or markets. You find new entrants are coming into your existing market, and basically businesses run out of steam. So you actually see an uptick. And whilst it's, you know, if there is going to be a sort of formal recession or the sort of recession we've seen historically, this one is going to be different, but some of the features are likely to be consistent. Now, what we've been talking about as advisors is, given that the government's invested so much in protecting jobs and resisting the rise in corporate insolvencies, surely it makes sense for them to continue to support. It doesn't make any sense, given the time, the effort, the money that they've invested, that they would just allow this all to fall off a cliff at the end of December, which is why I guess we've seen the furlough scheme being extended through to March next year, albeit not as quite on such generous terms. I certainly wouldn't be surprised if we see the stay on creditor action being extended through to the end of March as well, although that's always come a little bit later in the day, and sometimes even 2 or 3 days before it's due to expire, that seems to get rolled over. But there's also been some discussion around advisors and the referrer network around whether or not there's an argument that some of this debt should be converted to either really, really long-term debt or equity, or an equity type instrument, or even grants. And of course, all of this is happening at exactly the same time as Brexit. You didn't think we'd get away with presenting in November without mentioning at least once. And I'm well aware that by putting Brexit on a slide, I'm potentially opening a can of worms, and certainly we could speak for several hours just about this subject. But the point I wanted to sort of really raise around Brexit was around planning. We do a monthly survey of companies up and down the country just to sort of gauge how they're feeling at any point in time. And then because it's on a monthly basis, you can gauge how that sort of business sentiment is trending over time. And we've just published the results for November, and there were 2 statistics which sort of really stood out for me relating to Brexit, which I thought you might find interesting. And the first of those is that 80% of companies surveyed in our region actually had a Brexit plan ready to be, it's ready, it's planned, it's documented and ready to be implemented. So 80%. Nationally, that was closer to 60%. I think it was 63 to be exact. So it tells you just how insightful and prudent local businesses are. And the second statistic, which I'm just going to keep the big reveal for the moment, was around where businesses see their key risk for 2021. And at this moment, we're going to try a bit of a clever technology. If Kevin is able to make it work, we're going to do a flash poll, because I'd be interested to see how the participants on the call feel about 2021. So the question should pop up in just a moment, and it should give you the option to choose one of those options as to where you see the critical or the biggest risk to your business next year.
Danny, it's Kevin. Just to say, I'm having one technical issue. If you want to continue the rest of the slide, and I'll have the poll ready in about a minute. Fantastic.
Okay. Well, I'll tell you what we'll do. We will come back to that in a moment. You've let me down, Kevin. So in terms of the next part of the slide, so around M&A, and I often dial into calls. We do a sort of a stream-wide thing. So we'll have corporate finance, corporate restructuring, audit, so several different streams from BDO talking to other advisors and sort of sharing stories. So I'm well aware of what's going on in the other parts of BDO, and I can tell you that BDO's national corporate finance team are very busy, and we know that our competitors' corporate finance teams are also very busy. There is still a lot of M&A activity out there. There are lots of funds that are holding a lot of money that is burning a hole in their pocket, and that money really needs to find a home. So it's true that there was definitely a hiatus. So from March through to June, there was very little activity going on, and where there was activity, it was taking quite some time, but that's really definitely picked up, and our teams are absolutely flying at the moment. And what it means is there are options out there. So it may be options to acquire, and I'm currently advising two companies who are looking at a merger. They believe they can operate using just one cost base, so it will double revenue, double the gross profit, and they can strip out a huge amount of cost, and it puts to 1 + 1 + 1 = 6 effectively, to use one of the BDO monikers. So that's the M&A activity, but of course selling as well. There's interest out there. There are lots of, as I said, that money needs to find a home. So there are opportunities to sell. It might be the entire business. It might just be an underperforming division or factory, whatever it may be. So there are definitely opportunities there when it comes to M&A. Kevin, are we able to run that poll yet, or shall I keep going?
It should be up on screen now.
I can't see it.
We are receiving responses, so I will share the responses with you when they're completed.
Fantastic, thank you. So the question should be around, it's not popped up on my screen, but the question should be around, what do you see as the biggest risk to your company in 2021? I think broadly the categories should be Brexit, repaying the debt overhang, as we call it, a question around recession or a slow recovery, or none of the above.
I presume you can't see the figures. I will run through them for you, Danny. We had the biggest threat we've seen was market contraction or slow economic recovery, and the rest was kind of just one response across the rest, which are Brexit, none of the above, and ongoing COVID restrictions. And so it was market contraction, slow economic recovery is what most people went for.
Perfect. Thank you, Kevin. So that actually marries up pretty well with the national survey that was undertaken. So just to give you those numbers nationally, only 11% of those surveyed had Brexit listed as the biggest threat to their business in 2021. You wonder what if that survey had been done this time last year, you wonder what that percentage would have been, but my guess is significantly higher. 24% were concerned about having to repay this debt overhang, so more than twice the number of companies concerned about that debt overhang, and then 40% related to the recession and slow recovery. And actually, that really brings me on to this next point, which is around plan. And in fact, I could have written plan multiple times. So when it comes to surviving the emergency from this pandemic, those businesses which have a plan are the ones most likely to succeed. And that starts with a strategic plan. but that then filters down into your financial plan and your operational plan. But of course, you need to contingency plan as well. And if there's one thing that 2020 has taught us, is that things just do not go according to your expectation. You've got Brexit plan, which we've just been talking about as well, although hopefully most of the participants on this call have those plans in place already. But it's also around scenario planning, which is sort of picking the biggest 3 risks to your business and then asking yourselves, what the what if question, the what if scenarios. What if there is another lockdown at the early part of next year? What if there's no further liquidity being offered by either government incentives or by your existing funders? What if we have a full-blown recession next year? How are you going to survive that? Now, I wouldn't necessarily suggest that you plan in huge amounts of detail, but certainly having an outline plan to cover those critical risks to your business is going to be the key to surviving what is turbulent times. And the final point I wanted to make just before I hand over to John is around stakeholder engagement. And that could be incredibly important depending on the business and who your stakeholders are, but during these uncertain times. And it is possible to bring stakeholders inside the circle so they have a much better understanding of what's going on in the business, the pressures that you're facing and the risks. But also sharing some of your plans with them, proving that as management teams you're all over this, you've already considered what the key risks are and you have outlined plans to deal with that if possible. And those stakeholders could be varied depending on the business you are, but it's almost certainly going to include your bank, because let's face it, banks hate surprises, and you're going to need to ensure that you've got adequate funding to implement any plans and strategies you have to cover those contingencies. And that is a beautiful segue over to John as a banker for his presentation before we circle back for questions. So over to you, John.
Thank you for that, Danny. That is a very good introduction. So my name's John Stout and I work for the regional banking team that covers the Midlands and the Thames Valley region. And one of the reasons that I'm here today is that back in 2008, when we were in the global financial crisis, I worked for 5 years in the Lloyds Bank restructuring team. So I've had plenty of experience of dealing with companies going through turbulent times as a consequence of economic recession. But what I wanted to get across to help you in your relationships with the banks is to get an understanding of how we think about things and how we can work together to find solutions to problems. Next slide, please, Dan. So what we're going to cover this afternoon then is the impact on COVID-19 on how we do things today and why it's slightly different. How we go about deciding on what is the most appropriate funding structure for a particular business. The unusual department that's called credit and how they operate and why they're a little bit different to ourselves. And the end result of all this is very much to sort of give you a deeper insight into what goes on behind the scenes. So hopefully enabling you to get more out of your bank when you talk to them. Next slide, please. Oh dear. So, I mean, the interesting thing when COVID hit was that there were a number of considerations for the senior people within the bank as to what was the sort of the right approach to take. And literally all of the stakeholders shown on the left, shareholders, customers, PRA and Bank of England, were all very, very important and all the interests had to coalesce. So one of the first things that happened was that the Bank of England turned around to say that actually banks couldn't pay dividends. The reason for that was they wanted the banks to preserve capital so that they were sufficiently funded so they could provide the assistance for customers. So you can see that the Bank of England was putting the interests of customers ahead of shareholders, which is absolutely the right thing to do. And the PRA was insistent that we should do everything that we could do to make sure every business that was capable of surviving did actually get the opportunity to do that. So clearly going forward from sort of lockdown, customers were at the forefront of everything. And that just doesn't apply to Clydesdale and Yorkshire Bank. I mean, I talk to lots and lots of banks from all of the main banking brands, and every bank has adopted the same approach and continues to do so. Next slide, please. And essentially, therefore, between the PRA and the Bank of England, basically said to us, look, we needed to treat customers fairly, but we needed to maintain lending standards. And what that meant in practice was that providing a business was trading satisfactory on the run-up to COVID issues, we were basically being very much encouraged to continue supporting them through the difficult periods. And as a consequence of that, what we had to do, because we obviously had to protect our capital base, is we prioritised supporting existing customers and helping them through their issues and helping them to continue to grow before we actually gave capital away to potential new customers. However, now we're through the main difficult period, and as a consequence of that, we're now open for new opportunities, and all the other banks are the same. So there's more liquidity now in the market than there was through the first few months of this trading year. Next slide. So how do we decide on the right funding structure? Well, the first thing we look at more than anything else is the ability of any particular borrower to be able to service the proposed indebtedness. And the way we looked at it as COVID was sort of in the middle of lockdown was very much if the company concerned could afford to repay the debt based on pre-COVID trading, then we would do everything we could do to ensure that we could get them funding that they needed to actually trade through the crisis. The second thing we would look at would be, could the borrower provide enough security for the increased exposure? And we often found that that wasn't possible because we were quite well lent at the time COVID hit. And that's when we moved into the third criteria, which was whether the borrower was eligible for one of the government-backed loan schemes. And with that, we made every effort to ensure that every borrower that was eligible got the benefit. And that is still the culture today. And consequently, providing the borrower met the serviceability test and there was either already sufficient security or they were eligible for a government loan, they got funding. And that is exactly how we're approaching new requests today, as are the other banks. Next slide, please. So serviceability factors. Sometimes when I'm looking at a new lending request, people ask me why are so many questions? And the reality of that is because the economic environment is so uncertain these days, we're looking in more depth than we ever have done. And we consider all of the things that we think are relevant to the likely good performance of the business going forward. So we start off with historic sales usually and customer retention history, because that tells us the quality of the underlying business. Then we look at the quality of the product and how it's positioned against other products in the sector, the quality of relationships with clients and suppliers, barriers to entry, the quality of the management information, whether capital expenditure has been historically sufficient or there's going to be a problem going forward, and management experience. And then we look at the forecast growth rate over the next few years and actually form a view as to how likely that is based on history. But by doing all that analysis, we have a very good understanding of where the business sits in its particular market sector. And that gives us a lot of comfort, which enables us to take more commercial judgments on supportability of propositions. Next slide, please. So when we look at security, and obviously that's going to be impacted a little bit by the change in status of HMRC, but we look at all elements of the balance sheet, even more so than we have historically, because basically we want to be able to support companies that need to be supported, and banks can lend across all of the asset categories. You know, you obviously get less sort of a percentage for your inventory. You get good percentage for receivables and freeholds. But we try as much as possible to understand exactly how much security is available to make sure we can maximise our funding availability. Next slide, please. Now, we do all this, and then we have to take a proposal that we're happy to support to the credit team. And credit are interesting because they're there for a very good reason. They're there because they are highly analytical and typically like to identify potential problems. And a typical credit person will be the type of guy that basically says, well, I'm not going to do this unless you persuade me otherwise. So consequently, credit like consistency, and what they like is prudent forecasting history, because that gives them confidence with projections they're looking at, regular management information, so at any point in time they can feel in control, updated forecasts regularly, so if there's an issue, they know how it's going to impact the serviceability of the loan and they can react quickly. They like management that react quickly to issues that happen on a day-to-day basis. So when we're told of an issue, what management say is, this has happened, but we've done this. The company operating within its agreed limits, or if there is a problem, identifying the problem early and then speaking to us so we can get approval prior to there being a problem. And management owners that actually have a material equity stake in the company, because it makes them feel that we are equal financial stakeholders. And what credit don't like are sudden surprises, excesses that haven't been approved, management not being able to provide an explanation of variance to forecasts, and management have no detailed plans for tackling a problem. And so if you understand sort of the way they come at things, it enables people to prepare in advance of discussions with the bank to actually minimise the potential issues that can arise when the discussions finally happen with the credit team. Next slide, please. So in conclusion, we and all of the other banks are very much still open for business and very much keen to give our customers the support that they need. But we need more than ever a detailed understanding of what's happening within each business in order to provide credit with the necessary information to get them comfortable that what we're proposing to do makes sense in the current economic environment. And the strength is around structuring the facilities in the right way, having the right mixture of term debt, invoice discounting if necessary, asset finance or trade loans. And one of the problems I've seen relatively recently is a number of situations where people have used short-term facilities to buy long-term assets, which has created liquidity problems. And everybody in the banking sector is trying to adopt a thoroughly pragmatic approach. And very much the current wisdom is, look, we want to try and support all customers when they require the support, and we're going to try and be creative about it. In exceptional circumstances, though, we do have to seek independent financial reviews, or in normal times, we would not have to. But these are only necessary to help us develop a more informed opinion, which helps us, but also usually provides additional guidance to the borrower concerned. And the final thing is the relationship that the bank has with the management team is always key. So keeping us abreast of developments on a regular basis makes it much easier for us to assist you with the needs that you have. So thank you very much. But remember,
thank you, John. I think Gareth has access to the Q&A tab and is going to hopefully hold back the difficult questions and pass on the easy ones to me.
Good afternoon, everybody. Danny, John, thanks very much. Two really good sessions there, really informative. And as we've seen in the Q&A, there have been some good questions coming through. And Danny, sorry to disappoint you. There's some challenging ones in there as well. So Actually, Danny, I'll come to you first. A question came through around education sector, supply into education sector in particular. So sort of a business owner on the call, finding it a very competitive market pre-COVID, lots of pressure on margins, clearly lockdown, very challenging period with the school closures, then the homeschooling. And I think just looking forward, probably got some reservations really around how competitive that sector is going forward. You got any particular thoughts around supplies into education in particular, and then maybe in terms of the general work that you're doing, maybe you can open that out to maybe particular sectors where you're seeing sort of particular pressure at the moment?
It's interesting actually that education, it sounds like a planted question, this one, which I assure you it's not, but I'm one of 3 business restructuring partners who specialise in education, and I've been doing a lot in the space over the last 5 years. So this isn't just related to COVID. This has been a sector that's been struggling for some time. Most of my work pre-COVID was around further education colleges that have been going through the area review process and the government effectively forcing these colleges to merge. And I was actually appointed administrator over Hadlow and West Kent College last year under a special education administration regime. I'm doing a lot with independent schools at the moment, and HE is also suffering, particularly as a result of the drop in numbers of students, and particularly where they're reliant on foreign students, international students who were boarders. And if you think the average fee for a boarder is something around sort of 43 to 45,000, you don't need to lose many of them if you're a small school for it to make a huge impact on the bottom line. The reality is, in both HE and in both independent schools, there's winners and losers. Some of those schools are absolutely fine. If you look at the Eatons and the Harrows and those sorts of schools, they're not going to have a problem. It's the smaller schools at the bottom end that don't quite have either the facilities that they need or the exam results to compete internationally, because international students tend to choose schools based upon, do they look nice from the outside, but also where are they in the league tables? And if you're not on that first page of the top 10, 15, you're not going to get a look in, because it's very much around the academics. However, there are there's some good news there. So I'm currently selling a school at the moment, which is in a charity, but we're selling it to a for-profit organisation. There's a lot of Chinese interest in the education space. Chinese students tend to go either to the US or the UK. Because these two countries are seen as the world leaders in terms of education. However, for obvious reasons, the Chinese don't want to send their students to the US at the moment, because of the Cold War that's broken out, and secondly, because of their approach to COVID. So actually, we are expecting the market to pick up. The UK is still seen as a market leader, a beacon for the sector. So I would expect it to come back. I think next year will be challenging. Schools that went into this with low levels of working capital will struggle. If they own their own property, then there's bridging finance available, so they can probably fund their way through it. But if they don't have property that they can leverage, and if cash is tight, then it's going to be very, very challenging. The second question, I think you were talking about what other sectors. I think, it's the obvious ones really. I think pubs, bars, restaurants, they just had such a difficult year. Christmas is really difficult to tell how they're going to trade. Even if the doors are open, whether the restrictions mean that they're still only able to trade at sort of half cock. And next year, how do you plan for that? It's so difficult. They've got a relatively fixed overhead cost base, and it's all about that top line and how quickly these restrictions and the rule of 6, if it becomes the rule of 8 or the rule of 10, it's so difficult. So, and that's one where I'm afraid I just don't have the crystal ball.
Thanks, Danny. Really helpful, and I know sort of education, particular specialism of yours, so that was opportune. John, we've got sort of 2 or 3 questions on the banking on the banking side. Actually, I might try and sort of combine a couple of them, but one that's probably sort of sums things up where I think a number of businesses would be. I've got good security available, but I'm experiencing losses due to COVID. Would the bank look at providing funding, even though I'm unable to give 100% certainty on future income? Sort of 2021 is a total guess for my company right now. So I'm sure you're coming through a number of businesses experiencing that in terms of current trading and also uncertainty going forward. What's the way you'd respond to that, John?
Well, we've seen a number of situations like that. In reality, most of the businesses that have put forward forecasts for FY20 and FY21 are in exactly the same boat. They don't know with any degree of certainty, as we don't know with any degree of certainty what's going to happen. So the way we tend to look at it is not so much whether you're losing money now, is can we get comfortable over a reasonable time frame that you can get back to a level of trading that you're at before the outbreak of COVID that would enable you to service the increased level of funding at the same time where we're not overly exposed. And if that can be achieved, then we're looking in the main to be supportive. And it comes back to the way we evaluate how much security we've actually got, how far your losses can go before it creates a problem that is irreversible. But we do err on the side of being positive about things as opposed to negative.
Yeah, thanks, John. That's helpful. And I guess linked to that, somebody else raised a question saying for a loan that they've got that's maturing and is going to be extended for another period. For the first time, they've been asked to provide some forecasts to support the new loan request. Actually saying that, you know, at a time when sort of money is so tight and all costs are being monitored, that's another cost that they're now going to incur. And actually, when there's so much uncertainty, why put an extra cost on the business?
Yeah, no, and I totally appreciate that. And wherever possible, I try and avoid getting external parties to look at forecasts. I think it's important that all businesses in the current environment do their best to construct what they think is a worst case scenario forecast, so we can see how the business survives under those circumstances. But if the bank themselves don't feel comfortable in being able to analyse those forecasts to actually make sure that they're comfortable with the underlying assumptions, that doesn't really leave them much of an option other than to go and find somebody to provide some independent advice around that. But again, when we do that, we try and ensure that we keep the cost to a sensible proportion by using the right level of advisors for the right size of business and lending.
Yeah.
And we're
Thanks, John.
We're very conscious of it as well. You know, we don't want to deliberately incur people with what they might think as unnecessary costs.
Thank you, John. I'll give you a break for a moment or two, but looking at the questions coming in, I will be back to you.
Gareth, I just had a thing to raise on that forecasting point as well, actually. In fact, two points. I think the first is we all recognise how difficult it is to project accurately during these uncertain times. But actually, that's not something that's unique to COVID. There are plenty of businesses that always find it difficult to project what their revenues and costs are going to be because they operate in industries that it is hard to predict. So I would say that's not a reason not to forecast. You need to start with some assumptions. And we always say to companies, whatever you put down on paper today will be wrong tomorrow. Okay, we know that. It's a forecast. You're never going to be able to predict it accurately, but that's not a reason not to do it. And actually, I think most people have the ability to prepare a set of forecasts without the need to go to advisors. And in fact, the best forecasts are the simplest ones. The more complicated they are, the more likely they are to go wrong. And what you often find is a forecast that you knock up on Excel in the space of an hour is almost as accurate as one that you pay someone £50,000 to do that's got 50 spreadsheets that you can never be bothered to update. So Excel, keep it simple. Don't worry too much about whether it's accurate, but get some assumptions down. You can always then play with the numbers and the assumptions going forward. You can say, let's have a base case. Let's put down what I think will happen. And then let's take 10% off and let's add 10% and let's see what that looks like. So there's plenty of opportunities.
And there are also plenty of people that won't charge £50,000 for producing a set of forecasts.
Thanks both. Danny, another one for you. You touched on HMRC changing preferential status from 1st of December. I'd be interested in, I suppose, from the question here in two things. One, how supportive you're actually finding HMRC in terms of approach to business at the moment, if a business is facing some sort of cash flow pressure, and actually post 1st of December, if HMRC become preferential, do you think that will give them more flexibility to help?
That's a really good question. The first question we get asked quite a bit, even pre-COVID, is, I've got a problem, how do you think the HMRC will respond? And the answer is always the same, which is, it depends who you get on the phone. It really does come down sometimes to, if you get one individual as opposed to another, you will get a completely different outcome to that conversation. And I often go back to a scenario we had several years ago now, where we went to the revenue and said, we're acting for a client, they're struggling, there are significant arrears, but we can deal with those arrears over 18 months and you will be repaid in full. And the individual on the phone said, absolutely no way. There's no way we're going to give 18 months, you can have 6. And we said, 6 will never work. It's just impossible. So if it's 6, the only alternative is an insolvency. So he said, well, it's 6 or nothing. So we went away, we cut the numbers, and we came up with a company voluntary arrangement as an alternative, which saw the revenue getting 50p in the pound over 5 years. So we went back to the individual and said, well, we've got a CVA option. He said, different department. So we went through to the CVA department and said, you can have 50p in the pound over 5 years. And they said, yeah, that's fine. But it just shows you sometimes how HMRC respond to requests. They almost, hopefully there's no one online from HMRC, they almost don't see it as their money. It can be a bit of a box ticking exercise. Am I allowed to do this? Am I not allowed to do that? I don't want to take a commercial decision. However, on the whole, they are being relatively supportive. It still comes down to the individual that you're speaking with. If you can get through, because it's quite difficult to track them down, on the whole, they are supportive to requests for tweaks to time to pay arrangements that have been negotiated. The second question you asked was around post 1st of December, and I have no idea. I do not know whether that is going to change their response to these requests. They're so busy dealing with, furlough and all these other applications, that I wonder if they've actually had an edict on high, which says you need to change your response to requests for support because the preferential status has kicked in. I think what will be interesting is to see how they respond to CVA requests. Where they're potentially not, well, they can't be compromised, whether we then have to use the restructuring plan instead. So it is going to be interesting, but I'm afraid I don't know. We'll have to do another webinar in a month and I'll tell you.
All right, thanks Danny. And one last one for you. In terms of this question about Brexit, and somebody's asked, do we think the government or the banks will provide Brexit specific funding if things go really wrong? Clearly, we're not sure. Deal, no deal. Sort of what the outcome would be, particularly from the sort of, I'll say from the banks. I think for the banks, I think that we're reliant on the usual product range in terms of supporting business with change in transition. In terms of some government support, do you see any government support coming on Brexit?
It's a very good question. It's going to be a political hot potato, isn't it? I think that's going to be the point. If they provide that support, it's in support of business, it's rescue, it's restructuring. However, it's an admission that, and you can see how the press will jump on it, that if they're making additional funding support, it's because Brexit's a disaster and everyone told the government that businesses would fall over as a result of a no deal. So I can see politically they would prefer not to do that. I guess it's going to depend on the size of the issue. I expect they will assume if the number of potential failures is low, they will just allow them to fail. If it becomes a major issue coupled with what's going on with COVID, they may have to step in, but they might do it under more COVID support or under the guise of COVID support rather than Brexit support.
Yeah, thanks, Danny. And final question, John, is to you. Got a business who've posed a question, said they've taken out sort of one of the 2-year Sybil's loans sort of earlier this year, where there's a bullet repayment at the end of 2 years. At the time, they were forecasting they'd be back to normal, certainly by sort of mid-2021, probably a bit less certain about that now. So probably a bit of worry mounting around the ability to be able to do a bullet repayment after 2 years. That business, what should they do? Should they speak to the bank now about possibly restructuring that Sybil, or wait till the end of the term and sort of deal with the bank then about it, or hope for some other government intervention?
Well, I would certainly speak to the bank about it now and actually tell them why you're thinking what you're thinking. And that gives the bank time to think about the various options they've got sort of in terms of dealing with it. But it still comes back down to the same thing, is that the bank will be looking to try a solution, because it's still a COVID-related issue, and it's the fact that the economy hasn't recovered or isn't likely to recover at the same speed that everybody thought it would potentially when that Sybil's was taken out. And in the meantime, we'll all hope that the government actually does provide a bit more flexibility around some of those things. But I did a 2-year Sybil myself, so I'm watching it quite closely for the very same reason.
Yeah, no, absolutely. There's a lot of them about, and I'd agree with that discussion as early as possible. And the Sybil's loans are still open for application through till the end of January. There's one final question, which is actually around the Chancellor announced that the maximum term of Sybil's would be extended from 6 years to 10 years. Person's not heard anything from their bank about that yet. I'll pick that one up from a Clydesdale point of view. Certainly, when that was announced, the Sybil's loans were expected to come to an end at the end of November. Clearly, they've been extended for a different period. We're still doing a maximum term of 5 years. We've got 2 products, a 2-year and a 5-year product. There's no plans to change those before the end of January, but we do see the 10 years as actually giving us some flexibility going forward. Maybe if there's some issues on some loans, and also I think post-January the British Business Bank are going to launch sort of, it might not be a Sybil's type related, but I think we'll get back to a business as usual type product. We used to have the enterprise finance guarantee before, and again, that has some flexibility around 10 years. What wasn't going to be possible when you've done the thousands of loans that have been done across all the banking sector on a 2 or a 5 year basis. You can't just go and restructure all those to 10 years because 1, it's not the right thing for a lot of the businesses actually, and 2, in terms of cost of capital, cost of funding, a 10-year product is totally different to a 2 or a 5 year. So I don't think it was ever going to be feasible to go and do everything sort of in terms of looking at the back book. So thank you both for the questions. Thank you to everybody who submitted a question. Danny, I'll hand over to you to close for us.
Yes, thank you, Gareth. So thank yous all round. So thank you everyone for joining. Thank you to John for the presentation, and to Gareth for comparing the Q&A session so expertly, and Kevin for the technical side. Although apologies for I couldn't see the poll on my screen. We'll have to have a look at that and find out what went wrong. Just the final plug is to say that on the BDO website there's two areas you might want to visit. The first is the monthly stats, so you can go and see how that business sentiment is trading and see some of those statistics that I was talking about earlier. And there's also BDO's Rethink model, which has got some great ideas about how you can protect and preserve your business during uncertain times. Loads of great stuff on there, so I would direct you to the BDO website. Other than that, thank you again. Thank you for dialing in, and hopefully see you all again soon. Thank you very much. Thank you.